privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic, and we are ready to go. So how's everybody doing today? Things are fun. Let's see. The market is down a little teeny bit, which is not a big deal, and even the Russell's not even down, so who cares? That's hourly, daily. We had, the Dow hasn't really recovered. We have the strong bounce on the Dow, which was 30. So from 35 to 33 is 2,000 points. Let's see if we can zoom in on that. Not really, right? No, there's no particulars. All right, yeah. So from 35, basically over here, to 33 is 2,000 points. So you take the drop, 2,000 points, and you divide it by, or you multiply it by 0.2. So 20% of that drop is 400 points. So that becomes your weak bounce line. 20% of the drop or 20% of the rally is going to be your retracement. And so the drop to 3,300 gives you a 400 point bounce to 33.4. Sorry, that's a weak bounce right there. And you can see how it stalled at the weak bounce line. And then the next one is 38 right there. And that's a strong bounce. So basically in the Dow, all we've done, and isn't it funny how the 5% rule can totally predict this though, right? And well, not so much coming down. Coming down came down hard here and passed through. When you pass straight through the bounce line on the way down, you're going to go all the way down if you don't even have a bounce. On the way up, though, we saw it, and it's funny how the 5% rule tells you where you're going to have these plateaus at 3,800 on the way down. We did pause on the strong bounce line. And when you pause at the strong bounce line on the way down, you're probably going to come back and hit the strong bounce line. You're probably going to bounce back to it. So you can pretty much count on that. And that's why when you hit these significant resistance points like the next 1,000 line, after you see this sort of consolidation, so after 2 days of consolidation at the strong bounce line, you then you're either going to get over the strong bounce line or you're going to go down through the weak bounce line all the way down to the baseline over here. But when you hit the baseline, you're going to go back to the strong bounce line. So why ride it out? Why stay in the position? Okay, if you're betting, especially if you're doing index futures or something like that, get out and then come back in when you hit the strong bounce line if you feel strongly about getting back in. But there's no point in riding out an 800 point move against you in the futures. That's silly. What else? Oh, okay. So it's only the Dow though that's a real problem. But it only takes one for the whole thing to collapse, so you have to be careful. But the Dow has only strong bounced and it's not coming back. The Nasdaq is plowing right ahead. The Russell has also strong bounce, but probably 2350, 22 is 150, so that's 300 points. So 22.6 is the line. Oh, and here you go again. So you can do the calculation, and then when we go to check it, wait. What? Why did that look so different? Let's start that again. Oh, because the time frame, 2350 to 22. That's a very short time frame. That's just the month of June. That's why. So 2350 to 22 is a 1,500 point drop. So there you're going to get 30 point bounces to 2330 is a weak bounce. 2260, and you can see how that's a point. See how that matters here and here. So 2260 is a strong bounce. We're over the strong bounce line here, but it looks like it's weakening, so we'll see. You can't, it's hard to get there when you're this tight. This is intraday and stuff like that. You can't really, until you see 2 or 3 days consistently over the line without faltering, that's when you're really recovering. But nothing tragic happened. It's not a big recovery. There's nothing major here, but the weakness in the Dow is going to have to be a concern unless we can get over that 34,000 line and reestablish a breakout level. the others might begin to question theirs. And don't forget the S&P did similar stuff. It's up and down around the 4,200 line, but it hasn't really proven that it can burst forward from 4,200. The NASDAQ, that looks like it doesn't want to go back to 14,000. The Russell hasn't even, you know, is catching on this 2,300 line. They're all super toppy. And they're all super toppy because the average PE for the stocks for the S&P are like 35 times earnings. That's a crazy number. 15 times earnings is normal. 35 times earnings means you're paying double, more than double, what you would ordinarily pay for a stock. And you can't say that's the new normal, because it's only the new normal in the absence of any other possible thing to invest in. Now, that happens to be true, though, because you're getting paid less than half of what you should get in the bank. You're not keeping up with inflation. The interest the bank pays you doesn't keep you up with inflation. The interest a bond pays you doesn't keep you up with inflation. Therefore, anywhere else you put money, you're automatically losing money. Traditionally, you have a choice. You put your money in stocks, you put your money in bonds. Bonds keep you up with inflation safely, maintain the money that you have. Stocks go up and down, but generally are expected to rise probably 7-8% per year. That's normal for stocks. So your choice is usually a 3-4% bond, 3-4-5% bond, or a 7-8% stock. And since the stocks are less safe, there's a balance between stocks and bonds. You're getting paid less interest for the safety factor. But now you're getting 1%, 2% for bonds, and you're getting, really with inflation, 10% for stocks. So there's no choice. You have to put money in stocks. You really can't avoid it. And so no matter what crappy prices are being charged, as long as that discrepancy is there, as long as the market isn't actively falling, there's no reason for people not to put money in stock. That's an everyday, every week thing. And things snap right back. Bitcoin came back 20% today, I think. I mean, things are just, you know, when something comes out of the market, people rush into the next thing to invest in because, again, where else are you going to get any yield? You know, money chases returns, and the only returns being offered right now is in the stock market. Commodities are trickier and more dangerous, although they've been pretty consistently up. But on a monthly basis, I mean, if you look over here, we're only just getting back to the levels we were at in 2018. And since we're at these levels, look at gasoline. Gasoline is higher now than it was in 2018. So we're only just now getting back to these levels of the highs. Look at natural gas flying. If natural gas starts going, we could hit 450 on natural gas. So there are limits to how much consumers can afford. But again, those limits are now being distorted by the government because the government is handing out money. And this is the reason the reason oil was sustained over $100 during the Bush administration was because at the same exact time, he sent out checks to every family. At the time, I think it was like $300. It wasn't even a lot of money, but the only thing that was really out of control at the time was the gas. And he basically, what Bush did is he took the government's money, hundreds of billions of dollars, gave it to the people so they could spend it on gas. Which is basically, that's what a Republican oil man does. When you hire him to rob the government, that's what he does. He figures out a way to take government money and spend it on something that benefits his friends. So at the time, that's what happened. So, but it wasn't natural. And that's why we did so well betting against oil at the time, because it was an unnatural thing sustaining the price. And in reality, and I wrote extensively about this back at the time, You can't afford it. People can't afford over $100 a tank to fill up their car. It's going to change their habits. And it changes their habits in the short term and the long term. It means that every time someone goes to buy a car, they want to buy a more efficient car that uses less gasoline. Every time somebody makes a choice of going on a vacation, doing this or doing that, they're making a short-term choice to consume less fuel. People start taking the bus instead of driving themselves to work or whatever. All these little choices start adding up, and quickly demand like dies. So, the demand for gasoline in the US is 16 million, 17 million barrels a day. That's pretty steady, but it goes up and down a couple of percent, and you end up with a huge pileup, right? If 16 million barrels goes down 5% in demand, that means you're piling up 1 million barrels a day. That means 1 million barrels a day are not being used. That means at the end of the week, when you do the EIA report, you have a 7 million barrel build in gasoline. What happens when you have a 7 million barrel build in gasoline? The prices start plunging on the oil market. In fact, I don't even know what it is today. Obviously, something good happened today with the draw. We weren't paying attention, but let's see if we can find some news on that. But this run up in oil is just probably, I will see what the demand looks like, but it's probably just nonsense. And what they're doing is they always run up the price ahead of the July 4th weekend, because that's when you're going to go out and buy gasoline. And if you're going to go out and buy gasoline, they're going to make sure that they charge you as much as humanly possible. So they jack up the prices ahead of the demand. And some call that healthy speculation, and some call that a complete ripoff. You decide. Where are we? Oil. 1030. Roku. Ooh, somebody was talking about Roku the other day. Here we go. So the oil was a nice draw in oil. Oh, look at that. That's really good. 7.6 million barrel draw in oil, 2.9 million barrel draw in gasoline, and distillates were up 1.8. So still a healthy, 10 minus 2, so like an 8 million barrel net build in oil. I'm sorry, net draw in oil. So that's really good. That's the number they want. That's the number they want to see. Let's see if we can do the EIA here. June 11th, June 18th. Very good. Okay. Decrease 7.6. Let's see what the real inventory number is. Oh, yep, down 7 million barrels. See, it says 14, and we went down to 06. So there's no shenanigans, even if you count the all other oils, which went up. See, all other oils went up 3. That's a little bit off, but other than that, it's pretty on level. So you end up with a 7 million barrel overall draw. Exports were flat, so no change there. Production was the same. Utilization went up quite a bit. Inputs refineries. Now, product supplied. This is interesting, right? Product supplied was the same. So one thing that changed then is you've got 89.9, 90, and 91.2. So you have a 1.3% increase in refinery utilization. Now, here's the thing. How much do the refineries utilize? The refineries utilize 19 million barrels a day. Right? So if they're doing 19 million barrels a day, 19 times 7, not going to be a huge number, 133. So about 1 million barrels or so is being caused by the fact that there's more refineries online and they suck up oil, right? So the refinery comes online, it sucks up a certain amount of oil, and it's hard to say how much more oil, but at least 1 million or so barrels is being sucked up into the refineries. They put on a new refinery. Probably more than that, frankly, but it's hard to tell. But you just got to look at what the different factors are that could be affecting things. Now, interestingly, look what happened with distillates. They supplied a lot less distillates. That's interesting. If they supplied that much less distillate, oh, I guess they supplied more of the all other products. So the all other oils that is over here went we had a build of 3 million barrels because they started supplying more barrels, 300,000 a day. So that explains 2.1 million barrels right there. Not so, and they made less distillate fuel, and they made the same amount of gasoline as they made last week. So, nothing to really, there's nothing suspicious, nothing to read into this thing. It's just basically, it was a good week. There was good demand. Part of the reason there was good demand was because more refinery capacity came online. And if you turn, let's say a refinery, it's much more than 1 million. Because let's say a refinery is processing, well, if there's 19 million barrels a day equals 100% of the refinery, right? Then 19.5 times 0.013. So 250,000 barrels a day times 7, well, that's the number we got before. So 250,000 barrels a day is going to be throughputed in the refinery. But that's production. I think if you look at a refinery, though, what you'll see is an unused refinery doesn't have full tanks, doesn't have vats and so on and so forth that have oil, doesn't have storage internally that's not being counted as inventory because it hasn't gone through the process. So I think there's probably a startup cost to a refinery that probably sucks a lot of barrels out of inventory. So we haven't had a lot of refinery growth in a long time. So this is interesting, it's ramping up. But of course, on the other hand, they wouldn't be opening up refineries and turning them on and going to that expense unless they felt that it was necessary. So apparently the oil people feel that there is going to be a long-term return of demand. So they're looking at putting on more capacity as well. Look at it, I mean, look last year, 73% last year. That's crazy. There's 1/4 of our refineries we shut down last year at this time. Or not, it's not really 1/4 of the refineries because it's the capacity. So therefore, a refinery operating at 3/4 capacity would count. So what that tells you, though, is that basically that there's some fundamentals supporting a higher price of oil, but not $100 $100 a tank worth of oil. You know, not $3+ per gallon, $3.50. I don't even know what I pay for. I buy premium, so I get confused, but I think I'm paying almost $4 as far as I remember, and I think the base price is $3 for like regular gasoline, and that's just too much money. But yeah, the real limit is when the base price of like regular gasoline gets to $4, and that becomes $100 a tank for just regular drivers, and that's who can afford that? Come on, man, that's a lot of money. That's where you have to cut back on other stuff in order to gas up your car. So that is not good for the average person, and that's when you start destroying the demand. Short term, people can put up with anything, but long term, if it becomes a thing, it starts to erode confidence. Not only that, though, but of course, it's killing us for inflation. It's pushing all the input costs up. The cost of transporting goods and all this other crap is going up. Lots and lots of problems. And inflation, which we wrote about today, where are we? Tired already. All right, where are we? So inflation, which we were talking about today, is becoming endemic, and of course the Fed is saying inflation is transitory, which means it's going to go away shortly. It's just a glitch. They consider inflation to be a glitch, whereas what's going to get backed out? All right, so what are the causes of inflation? Causes of inflation are higher commodity costs, which are partially being caused due to shortages in labor and so on and so forth. The same problem people have hiring and opening up manufacturing, and the fact that things have been closed and are only just now reopening, like refineries, right? 1% more refineries came online. 1% more people are working in refineries this week compared to last week. So that's increasing production capacity, but it comes incrementally. So yeah, if you have shortages of product, and then the 1% more manufacturing capacity for gasoline will alleviate the shortage of gasoline and hopefully, and in theory, drive down the price slightly. So that's where you get transitory inflation, although obviously refinery utilization is not the cause of the oil price. But in every business, that's, excuse me, in every business, that's the way it's flowing through. And you just have to think about like what's driving the cost. So in other words, when you see the Uber drivers and the DoorDash people and whatever, walking around the streets with signs saying Uber is unfair, DoorDash is unfair, we're not getting paid wages, blah blah blah. You have to think about how is this going to affect me. And this is how people turn Republican, because it's funny because you think about it and you're like, well, that's just going to cost me money. I mean, these drivers want living wages, and therefore I'm going to end up having to pay like $5 extra to get my tacos, And I don't know if you guys do that, but I mean, I literally, I just out of principle, I can't do it. Sometimes I punch up an order in, I mostly use Grubhub. That's my favorite, just because I like the interface of Grubhub. It's very comfortable, and it's really good at remembering what you ordered previously and so on and so forth. So I tend to use Grubhub a lot, but they're expensive. They're much more expensive than like DoorDash is. And Uber Eats is also expensive, but I don't use them very much. But I use DoorDash or Grubhub. I use DoorDash only because Jackie works there, and I started getting used to that app, but their app sucks. I don't know how they can be such a big company and their app is like from the Stone Ages. But Grubhub has a nice interface. It's my favorite one. And but when I get to the end, sometimes I look at the thing and I'm like, wait a minute, I just ordered like guacamole and some nachos from the Mexican place, and that would be like $20 if I sat down there and had a sangria with that, and they're charging me 30. And it's crazy, okay, it's my fault. I tipped the driver and whatever, but it's not only because I tipped the driver. I mean, it's like $7 maybe $4 I tipped the driver, and then there's $6 of upcharges on the thing, and that's crazy. And I'll cancel the order. I just out of principle. I'm like, I'm not paying $30 or pizza. That's another one that they get you on. It's with the pizza, same thing. The $20-something pizza, and they charge me $30. And I'm like, I'm not paying this. I can go get it. It's just crazy. But that's inflation. That's how that affects you. So when you see these DoorDash people walking around with signs saying we're being unfairly compensated, blah blah blah, and that's funny. My daughter's like, I don't think this is great money, but she's a kid. She's the person who should be doing that job. Pizza, like Domino's pizza guys, are not meant to be PhDs in physics, right? It's supposed to be like kids who are getting their first job. That's a Domino's pizza guy. That's what the DoorDash person should be. But yeah, because when they were labor protesting, because Jackie's never experienced labor protest before, and I said to her, well, what are you thinking? What are your friends thinking, DoorDash? And she's like, we all think this is crazy. They're like, we're happy to work more. If they don't want to work, we'll work. But it affects you, right? All that affects you. It trickles up to the price you pay for things, and that inflation is not going to go away. How is that going to get given back? And, yes, the cyclical stuff, the cost of food, the input cost, Chipotle. Funny how no one gives a crap anymore. It used to be Chipotle, if the price of avocados went up, the Chipotle stock would fall because they were like, oh, their costs are going up. But the labor costs have gone up tremendously because of the minimum wage thing. Everybody acts like that doesn't matter. But that's true for all these restaurants. They all have increased labor costs. They have increased food costs now. They use natural gas, which has gone crazy. Where is my natural gas? Give me a shout out, natural gas. Natural gas, which was, well, forget that. Forget last year. But natural gas was pretty happily skating around. No more than $3. This goes back to when? To 2016. long-term basis, you get these spikes, right? But natural gas is now getting to the point where it starts to become expensive and it becomes a problem for people who use natural gas, restaurants for cooking, heating, things like that. And you have to think, and natural gas is an input cost for industry too. A lot of industry uses a lot of natural gas for various processes that they work on. So we could be heading into a big move up in natural gas. It'll come back to $4, and I'm not looking to bet on it. But we expected this anyway because of the LNG exports. Globally, natural gas is, well, it was much higher. It was, you were paying up to $10 in Asia for natural gas, and in Europe they were paying like $6, and in the US we were down around here. That's why we're exporting it. That's why it's such a big deal for us to export our natural gas. We have tons of it. We're like the Saudi Arabia for natural gas. We have the most natural gas in the world, and liquefied natural gas allows us to export it. So what happens if we export it? Well, their natural gas prices come down because now it's going to be a blend for the world, right? So their prices will come down, Europe's prices will come down, and ours will go up. And 450 is my predicted. If you can go back to back around this time when I used to predict that 450 would be the right price for natural gas. I've always said that. So eventually that's where we're going to settle in. Globally, if you have liquefied natural gas and you can move it anywhere you want, you end up with a global average price, and the global average price is going to be probably about 450. So a bit more expensive for us, a bit less expensive for everyone else. But that's interesting because you look at prices in Europe for a lot of things are higher than ours. They pay more for things like that. They pay more for fuel. They pay more for natural gas. They pay more for labor. They have higher minimum wages than we do. So when you look at this stuff and you say, well, this is transitory. How is this transitory? This is the future. This is where we're going to be. We are in the middle of a price adjustment. We've been benefiting from things that are ending, like ridiculously low labor prices and ridiculously low fuel prices. And that's going to stop. And the stoppage of a benefit doesn't mean that, as with Social Security, right? The stoppage of a benefit doesn't mean you're going to be better off. You're not. And so it's not inflation so much as it is a repricing to the norm. We had exceptionally low prices, and now we're moving into more normal prices on a globally competitive scale. So I don't see this as transitory at all. I don't see what we're going to give back. Yes, commodities can fluctuate. Natural gas, obviously, at one, it went crazy for a while. But this is all, Enron BS and whatever. But, natural gas went nuts for a while, came back down, calmed back down to the normal levels that it is for the supply of the United States. Lumber just had a crazy ride, and somebody, look at this. Holy crap. This is a monthly. Look at the weekly. Yeah, there you go. Look at what happened to lumber in the last couple of months, right? And what cracks me up is when you look back and you read the articles, people were writing, when is this date? Does the state say? There, May 7th. A month ago, a month and a half ago. So a month and a half ago, there were articles talking about how lumber is going to go to 3,000, blah, 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 blah. And people write these articles and they tell you this stuff, and then the exact opposite thing happens, and there's no accountability whatsoever. None. They don't take that reporter off the pool. They don't give him a demerit. They don't say you're no longer in charge of the commodities writing. Never happens. They can just write anything they want, and there's no consequences to just bullshitting your way through an article. And all they do is they watch a trend and they just predict it's going to go forever. All these people jump on the bandwagon to write stories. And it's not like we have the balls to short it or anything like that, but just you have to know this about commodities, is they do spike once in a while. And it does happen here, sugar spiking, right? And then this went on for a long time. This went on for a very long period. Wait, actually, we can do monthly. So sugar from 2009 to 2012, 13, that's a 4-year run, was really crazy. Coffee had a run, right? And we played coffee because when coffee came back down here, we jumped all over it down around this line. We like coffee. At 100, we definitely love coffee. We started playing with it when it was here, and then it fell to 100, and every time it hit 100, we were buying it. Orange juice usually is weather related when it spikes up. It's usually crop issues and whatever. But see how you can kind of predict these? So frankly, I'd buy some orange juice now, right? Look, this is 2007, 2009, 2 years, right? 2012 is 3 years. Then we've got 2015 is the low, that's 3 years. Then we're back up from the low to the high in just 1 year, basically. And now we've had a low from 2017 to 2021. So we had 4 years of pretty low prices. And you know the environment's screwed up. All right, although it's screwed up in a way that keeps it warmer. Mostly oranges mostly get killed by not drought, the opposite drought, frost. Frost kills oranges. If there's frost, they can't survive it. So warming is good for oranges, but drought is not good for oranges. And on the whole, I think even if we do end up going lower, but it's unfortunate it's lower, it's really expensive if you get this wrong. But even if we do go lower, I think long term we are at a good low to put money into orange juice. So if you're into that kind of investing, that's kind of fun. Here's a spike in cotton that was totally crazy, right? And you see, and this is when it's happening, people are like, "Oh, we can never afford T-shirts again. Our T-shirt's going to be $100." People have no idea what they're talking about. So take everything with a grain of salt. Except salt goes up and down too in price. But take things with a grain of salt. The dollar is still pretty low, although it had an interesting little bounce recently. So here's the dollar going up 2% in the last couple of weeks. That's good. Now that's been putting pressure on the indexes. So they are thinking if it comes down, we can get a nice boost to the indexes if it comes back down. But will it come back down? Now you have to think about, well, what news is going to make it come back down? What's Biden going to say? You know, what is the Fed going to say? Well, the Fed just said they think inflation is transitory. That's weak for the dollar because it means they're going to keep easing and so on and so forth. Where would I buy OJ lumber, etc.? I don't see it on Thinkorswim. You have to get an account with the CBOT. I'm not sure. I don't think Thinkorswim trades a. I don't want to get into it now, but yeah, you can't trade on Thinkorswim. You have to open an account at the Mercantile Exchange on the CME or something like that. You can get those accounts. They're easy to get. You just you find a broker who puts those up. But it's, you know, you got to be careful. It's dangerous stuff to trade. These are big contracts. They swing wildly. You got to have a good reserve. Don't take it lightly if you're going to start messing around with that stuff. I mean, you're playing against very professional traders when you're into that section. I just think trend-wise, though, it's a pretty obvious trend. I mean, it seems like we're at a good low. You know, any soft commodity like that, when you look at a really long-term chart, you just think about, like, why would it go lower than the lowest? You know, what's going to cause it? You know, how are we going to have a sudden abundance? What's going to cause an abundance of oranges, or what's going to cause oranges use to drop off and demand for oranges to drop off? You know, and if you can't see that, well, then that means anything that disrupts it is going to send it higher. So, you know, when I see things like that, we take advantage of it. That's why when coffee was down here, we were like, oh yeah, that's fantastic. That's like as low as I've seen it in years. And then what do you think? In fact, my logic when we were doing the coffee, I said, look, oh, I know what it was. It's the same thing as what we were just talking about with DoorDash. There were coffee farmers going on strike. They said we can't afford to sell coffee at these prices, because in other words, the coffee guy, the poor coffee farmer, is not a speculator. You know, it's some guy in Guatemala growing beans in his backyard, you know, on his farm, and I mean, obviously there's a lot of big plantations and whatever, but the point is, they're, these coffee farmers, this is their life, this is their crop. And the company Starbucks comes to them, because Starbucks is always proud of how they deal with the small farmers, because they can twist the arms of the small farmers pretty easily. So Starbucks loves to deal with the small farmers and tells you how wonderful they are for doing that, but meanwhile they're squeezing them on prices. So these guys are just growing a crop, and they've got a fixed cost, right? So for years and years and years, they've got this farm. Okay, so this guy's had a farm all these years, and maybe they were bad years before. Maybe he bought the farm when it was cheap, because somebody had a bad time. But he's had years and years, and he had some good years, and then he came back, and now he's like scrabbling out in existence. Had a good year, comes back, scrabbles, has a decent year, good, scrambles, but more or less good, decent years. But then when the price goes all the way down to 100, this guy's like, whoa. You can't drop the price from what you think. When the price drops from 140 to 100, this guy's ready to cut his expenses by 20% or 40%. No, it's killing him. You got to be realistic. These guys can't survive on that. They can't cut 30% on the expense on their farm. It's not like they have hundreds of people or whatever. It just doesn't work that way. It's like, the coffee has to be picked. Somebody has to go out and get it, and it doesn't matter if you don't want it, or if you want, or you want to pay less. It costs him just as much to do it. And that's where you find the base in a commodity. The same thing happened with gold. Energy, nope, metal. That's what gold is. It's metal. And the same thing happened with gold back here, when I was pounding the table on gold back in this part of this time, because the cost of gold. I mean, we're talking $600, and I'm sorry, but $600 is what it costs to pull gold out of the ground. That was because the energy prices went up. So when the energy prices went up, the base cost of gold went up. During the Clinton years, and even into Bush, I mean, we had oil was down around $20, $30 a barrel, $40 a barrel. From here forward, it was $40, $50, $60 a barrel, and that's a big input cost for the miners, and that caused that cost to permanently go up. And so, and again, it goes back to the same thing. Once the cost goes up at a certain point, it's not going to go down, because if inflation is sustained for like a year, then people are pricing in their entire business model around a certain price, and it becomes very, very difficult to roll it back, because you start planning on that. So in other words, when gold used to be $200-300 to pull out of the ground, and $290 you're making a good profit percentage-wise, then it's fine. But when gold suddenly becomes $600 to pull out of the ground, and you're only selling it for $650, all of a sudden your profit margin is worse than when it was $300 if you're a miner. And you're making decisions based on that. When gold is good and flying high, and you're making margins, and you're used to 50% margins, if you can't sustain the 50% margin, it wrecks your business. So everything's interconnected, and you got to think of, when you're looking into stock, you got to think of all these interconnected pieces. But it also then extrapolates out to globally. How is inflation going to suddenly go away? How does the Fed think it's going to go away? They think that, well, they don't think that. This is their bullshit. They know it's bullshit, but they're saying that it's transitory. Why is it going to be transitory? It's going to be transitory because currently we're coming out of a crisis, and we're recovering economically faster than we're turning our manufacturing back on, and therefore there's a lot of delays and log jams of products, and that's forcing people to scramble for product to meet the demand. So demand goes back to normal before production goes back to normal, and therefore eventually production will catch up with demand. But the problem is, to get production back to normal, they are raising wages, and they are not going to be able to cut these wages down the road afterwards. The next thing that's going to start happening is they're going to start offering benefits. And notice companies are not doing that. They're offering bonuses for signing up, but they're not offering health care or anything like that like they used to have, because they know that that is a noose around their necks when they have to start providing health care to people, or retirement plans and things like that. Not that you really want a retirement plan from your company, frankly, because the amount of companies with retirement plans that are underwater in this country is startling. I mean, there are so many people in this country who have no idea how badly underfunded their pension plans are. And so that's a big problem as the boomers retire, because a lot of these company pension plans are still looking to collapse. That's what took GE down. GE, the whole knock on them was that their pension plan was woefully underfunded, and they had to come up with tens of billions of dollars to get the pension plan back up to speed. And that's, you know, when you're an investor and you're like, well, wait, what are you doing with my profits? You're giving it to the workers? It's like, give me a break. But GE recovered nicely. Too late for me, though. We gave up on it, right? But I thought that they were really overblowing the, what is this doing? You can't do that? 5 years? No, you can do 5 years. Oh, dear. Oh, okay. It works just slowly. Go back to max. Isn't that weird? So slow. Oh, now it's non-responsive. There we go. Holy shit. Well, that doesn't really tell the story. Oh, there we go. That's what I was talking about. Gotta pull the chart out. So as you guys know, when GE was coming down around $10, I think I was getting really excited about it because $10 is about as low as it went in 2009. I was like, yeah, I'm like, okay, $10 for GE is great. It did not do well. It was very jaggedy. It was around this time that we were buying GE, and it was not doing well, and finally just came back to like where we came in, and we were like, okay, screw it, because they're not working. But you know, well, not that I had the balls to get back in last year, right? But they went down to $6, and now they're back to $13. But you know, the point is, this was all about their pension plan. It all started falling apart like this because of the pension plan and people's worries about how they're going to do this and how they're going to do that. Now, if we look at GE, see that bankruptcy risk? That's crazy for such a big company, right? But the thing is, this is the problem. They still have a lot of issues that have to be addressed inside the company internally. Can they address them? Yeah, probably. But look at the hits they took. They took this hit to adjust their pension plan, to fix it. They took $30 billion out of cash or out of the company and put it into funding the plan, which is a past obligation, so it doesn't do anything for them to fix the company or improve it in any way. They spun off divisions to reduce debt, so on and so forth, and they now are a smaller company than they were, and now they're kind of into a rebuilding phase. But they were at one point making, well, it's kind of erratic looking, but they were making like $5 billion a year, and we're getting a valuation of about $100 billion. Now they're still $100 billion, and they're just kind of getting back to like $5 billion next year, they think. But like everything else in the market, it's overvalued currently. But long term, the point about GE long term though is it's GE. They're going to recover. They're going to rebuild. They're going to get into whatever is profitable, and they'll move forward. But it's been a much harder road than I thought it would be. I'm surprised how rough it's been for them to turn this around. And now they're not cheap anymore. So at $5, yeah, I think they're worth a shot. But at $13, it's just not worth trying. Shouldn't have risk at that kind of prices. All right, good. Okay, so what else is happening? Do we have a calendar? No, we don't have a calendar. Okay, well, doesn't matter. I don't think anything's going on today anyway. What else are we talking about? Oh, yes, right. We did portfolio review this week. We'll take a quick look at some of that stuff. Or actually, all right, well, we did top trade review yesterday. And just to sum it up, I mean, look, these are great trades. and they're no different than all the other trades we put in PSW. But when I'm making a trade and I think it's got a very high probability of success, that's what I consider a top trade, one that is very likely to succeed. Not 50-50, it's got to be like 75, 80, in my mind, 75 to 80% chance of success. Or really, I'd say 80% chance. It has to be an 80% chance in my mind. It ends up being a bit below that sometimes. Although right now we're at like 90 something. We're about 90% successful because I think I forgot 14 out of 15 or something like that we're good. But this is the first quarter of last year, which was a weird quarter, of course, because of the crash. And so the kind of trades we picked were H&R Block. I always like H&R Block in the spring. In fact, this was my losing trade. H&R Block is always good in the spring because people forget about them. I think, so in other words, if they're down in January, if they're down in the fall or down in the spring, what happens is around tax season, people who are doing their tax returns with H&R Block start remembering all the ads on TV also, starts reminding people, oh yeah, H&R Block, that's a good little company, blah, blah, blah. So if they're at a good value, not just randomly if they're low, but if they're low and showing a good valuation, then yeah, that's people are going to notice them, and that's your catalyst. Your catalyst is people are going to get them on their mind. It's going to cause them to sit down at a computer, because you must do that, right? You see a commercial on TV, and you sit down at your computer or you punch in on your iPad and you say, oh, well, let's see what that stock looks like right now. That's what happens. That's how buying decisions happen. That's what causes an analyst to write an article, right? So when you start seeing a lot of ads for something, that's actually a good thing. I used to read, in fact, Advertising Age, which is actually a great mag. I mean, I like it. I'm interested in advertising. I'm always interested in the manipulation of people through media. That's what I actually like. But is it just called Ad Age? I think it might be called adage.com. I think. Dun, 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 dun. Oh, cool. Wendy's. I like that. Anyway, I don't know if this is Advertising Age, though. Is Advertising Age a different thing? Doesn't look like them. Advertising. Come on, Google. You can't figure that out? Advertising Age. Nope. Not agency, Age. Advertising Age magazine. There you go. Thank you. Oh, it's adage.com. Yeah, it is. Okay. Fine. Huh. Boy, I don't like the look. I'm not a fan of how they actually look now. All right. Anyway, adage.com. I love it. It's so interesting, and it's also great insight into what's happening. Marriott is doing a huge global campaign as travel rebounds. Okay, this is the catalyst, and so now you look at Marriott and you think to yourself, okay, are people undervaluing Marriott? They're not, though. I'll tell you, because I've looked at Marriott recently. So Marriott's now at $46 billion, $46.5 billion. They're not even making $1 billion. So that's not one I would be worried about looking at. Oh, that looks like the Ad Age proper logo. Okay. This thing with Wendy's, though, that's interesting. Okay, but it's a lot of kids, but it's something that'll bring people in. You look at the different how brands play a role. Reddit, Burger King, social influence, Coca-Cola, blah, blah, blah. Anyway, you look and see who's doing something interesting, and it's not something that most investors think about. It's like, what is their promotional plan? If somebody's running a huge promotion in the next quarter, you'll read about it in Advertising Age. You will not read about it in the regular financial news because they don't consider it important. But I think when something is brought to the forefront like that, it's something really great to know. So I used to love reading Ad Age to make those bets on stocks that were about to move. But that goes back to top trade. So that's one of the things in the back of my mind I keep aware of in top trade alerts is the industry, is the sector getting attention? Are things happening? How is Wendy's doing? We used to play Wendy's. They were way undervalued for a long time. Wow, look at that spike. What the hell? $5.2 billion and only 200 million sales. You know, it's not good enough. They were doing better though. They made, all right, let's see. So 200 million here, 500 million there, 450, then back down a lot. What did they do? They must have, this must have been some one-time sale thing. So basically, they're only dropping like 15% to the bottom line if they're lucky. And these projections are more like 10% to the bottom line. So they're very unlikely. In fact, you can see that trend, right, for sales. They're very unlikely to get past 250, 300 million in sales, and you're already being charged for basically 300 million in profit. Sorry, you're already being charged for 300 million in profit, and they're not going to get there for a long time. So no, not of interest, even though there's some catalysts. On the other hand, though, I think they're good for a solid 4 billion, and that means that they probably fit. They're pretty steady overall. See how they're very steady with their growth. And we liked them back when they were like $5 or something for a while. This is when we liked Wendy's. Yeah, back here. So back here they were woefully undervalued, but now now it's like 5 times higher than it was, or 4 times higher. But they are a steady general grower, and you can expect there's no reason they won't keep going like that for them. They're a good, nice company. They have a niche. They're not, McDonald's isn't worried about them. Burger King's not worried about them. They have $2 billion in sales. But as you can see from this thing, they're innovative. They try stuff, and they are, and they're always looking to grow and push and do whatever. So, where was I? Anyway, so I like them, as in I would bet them to stay. What are they at now? 23, and if we say 20% down from here, so let's say $5 is 18. So I would like them to play them over 18, and figure take a spread like there's Yahoo. Yeah, it's terrible for spreads though. Wendy's. Where's the proper thing? Back. They're going to take me to finance? No. It's exhausting, all these things. So if we look at Wendy's options, whoa. So I have a premise. My premise is they stay above 18. And that means in 2023, I look and see if it's worth playing like that. And in this case, let's say we pick up the 18 calls and they're 650. And let's say we sell, now it's starting to look attractive though, because we can sell the 22 calls for 420. That's only a $2 spread for $4. So now I say, okay, well, wait a minute. What if I could do this spread instead? We can do the 15-20 spread, but that's $4. That's not fun. We don't want to do that. So it looks like that is the best one. The 15, $9 bid 750, ask 9. So it's probably lower than that. Probably can get a better price. But anyway, so obviously you can get a better price than 910. But let's say even if it was 850 and 5, 350. Oh, I can make that work. That's what I would do then. I would go for the 15-20 spread if it can be gotten for what do we say, 350. If we can get this for 350, it's a $5 spread. I wouldn't pay a penny more. But if we can get that spread 15-20 for $5, and then we sell, what's the magic number? 18. If we sell the $18 puts for $1.30, is that worth it? I wouldn't sell them for $1.30. I would go for the spread for $3.50, which has a nice $1.50 upside. It's like 40% upside. I would do that, and if Wendy's goes lower, then I would sell the 18 puts for $2. So I'd be waiting to sell the $18 puts for $2. If they never sell for that would knock you down to $2.50 on the spread. So if you never sell them, the only reason you would never sell them is because Wendy's keeps going up, and if Wendy's keeps going up, then you're going to make $1.50 with no margin and no anything else, just on the spread. So you're either going to make $1.50 on the spread, or it'll drop at some point, you'll sell the puts, and then you have the upside of $2.50 on the spread instead, and hopefully it comes back on you. So that's the spread I would look at for Wendy's. And then obviously it's not paying off 3 times 4, so it's not thrilling. It wouldn't become like a top trade or anything like that, but it's a nice little trade on Wendy's, and we think it's going to chug along and keep doing what it's doing. But anyway, so that's the point, that you just look for things that are interesting. That's how we come up with these top trades. But it has to be timing. Usually it's going to be because of a catalyst. And the reason I pick Wendy's is because I'm looking at Ad Age and I say, oh, that's good. Rick and Morty, I know that's really popular with the kids. And this is a cool little theme with immersive pop-ups and things like that. And it's funny because it's getting harder to relate to some of these things, right? This means that you go into Wendy's and the kids are looking on their phones and they're seeing this whole little world going on with cartoon characters running around and so on and so forth. And it's like the Pokemon thing, right? Like things are popping up in the real world on their phones and they can view it. It's really weird. It's very hard to relate to what's happening because our kids live in a totally different world than we do. They're like, so their phone is such a total part of them. And they just don't think twice about stuff like this. It's perfectly natural. It's kind of cool, actually. I like it. So where are we? Oh yeah, that's right. Top trades. So IMAX, I always like IMAX. Middleby is they provide restaurant equipment, mostly ovens and stuff. They also make Viking grills. Love Viking grills. Viacom, of course, you guys know how much I love Viacom. The Discover Financial was an easy pick. That was way too cheap. SKT, you guys know I love SKT. SunPower. See, none of these picks are surprising, right? Oh, look at SunPower. Nice day. All right, good. All right, nothing is surprising here because I talk about this stuff all the time. Walgreens boots. Oh no, Phil picked Walgreens boots. What a surprise. Six Flags, don't usually talk about that, but they were just so cheap I just couldn't resist. Mountain is Vail Resorts. Vail Resorts they of course run the ski mountains. They just bought Hunter Mountain, which I had a condo in, so I'm kind of pleased about that. I have a condo in Hunter in New York, and they just bought that mountain. So they're running around buying all these ski mountains that are going having problems because of they had problems with the COVID, they had problems with the economy, but it's Vail, so they have money no matter what happens. And frankly, I mean, honestly, it's like even if it's warm, Vail's beautiful. It's like a great place to go on vacation, whether it's snowing or not. So and what they do is they make money not just on the skiing, but they make money on on condo rentals. They own properties. They have hotels. They rent out land. They have retail space that they rent out. They're really good, smart operators, and they're just a good long-term story, these guys. Not cheap now at all. MTN. But they were cheap. Now they're at $13 billion. And again, bullshit. You know, for $400 million in earnings, I'm paying $13 billion. I was happy to pay, because it's 2 years ago, right? So 2 years ago, in early 2020, I was happy to pay. I don't even know where it was. Where was it at the time? Oh, this was March. This is because it crashed, right? So because it crashed, it's a stock I know very well, And we picked it up while it was crashing. I imagine it's probably about mid-March here. So at $200 or 175 or whatever it was, half this price, I was happy to pick it up because this was a normal price to them because they're a good growth company. In fact, check this out. I mean, see the revenues from 2015. So not, well, they got dinged, of course, in 2020, but generally, this is a super company that's on a growth path, and they just get right back on the horse in 2022, as you can see, and they're back to growing and 326. So they'll be at 5, and at 5, they're good for $10 billion, but they shouldn't be at 13 billion now. They're a little ahead of themselves now, but a great stock. Teva Pharmaceutical, good steady company, is actually cheap right now. We made money. Wait. Oh, I see. It's up here. Sorry. We made money because we had a conservative 410 spread. Just like, in fact, just like the Wendy's one we were just talking about, right? That's what I did with Teva. Took a conservative spread because I said, well, at least I know where the low is. I don't know where they're going to go to, but I know that they shouldn't go any lower than this. So we were going to make money no matter what, and they're right at the spot where we thought they'd be. And here's Viacom again. Oh, not Viacom. This is Vacation. This is a Marriott Vacation. Oh, it's Marriott again. It's Vacation Club. This is a vacation, isn't it? Pretty sure I got that right. I think it was Marriott's Vacation Club. Yeah. So this is it, like Vail, right? Because Vail is one combined company. Marriott has a split out. Their timeshares is what you call Marriott Vacations, and that's also a phenomenal company. It's just unbelievable how much money you make in this business. And people thought it was going to hurt them. Keeps flipping back and forth. So people thought that it was going to hurt them, but they don't understand. This is a management company. You're stuck. You already bought the timeshare. You already own the property that they're renting out. If they don't rent it out, it doesn't hurt them. It hurts you because they're the management company. Yes, they'll get less revenues, but they don't have a lot of sink costs that go into it. And as you can see, I mean, this is painful. They lost $275 million last year, but it's painful. But it's not like they're losing money on the property, and they were being priced down as if they were like losing their money on the properties. They sold the properties already. So people came in, bought these things out, and bought the timeshare. And the greatest thing about this, and I tried to do this right here, I tried to get people interested in this idea in Las Vegas back in the last crash in 2008. Because this is how it works. It's like I wanted to buy in Las Vegas. There's a building called Veer, which is right over the strip in the middle. It's right next to the Aria Hotel, and it's all residential. But what I wanted to do was buy, because these things were going for like 1/3 of the original price or 1/4 of the original price during the 2008 crash. Because two things happened. They had the crash in 2008, and there was a problem in the building with noise because the wind would come through the building. The way it was designed, it made a horrible sound. And people were acting like they couldn't fix it. And I was like, they said they can fix it. They're going to fix it. It's just going to take a while. But people were dumping apartments out of there. And I wanted to buy 2 floors of the building and then rent them out. So buy like 20, 30, 40 apartments, depending, and then put a concierge desk on the floor, and then rent it out like a hotel room and have people come and stay. And that would have been fantastic. And the way it works, though, is you buy the condos and then you sell them as timeshares. So you sell off the pieces and quarters. So you make the money already selling the timeshares, but then you charge the people you just sold the timeshare to 50% of the rents to manage the properties. So you're collecting half the rent. You don't own the property. They already paid you a profit on the property. And then you just sit there and roll in money for running a stupid Airbnb, basically for running an Airbnb. That's what you're effectively doing. Of course, you got to run the cleaning staff and all that crap. But I mean, honestly, it's like such an incredible way to do things. But people wouldn't, well, nobody, I mean, everybody's freaking out about money back then, but I was just like, oh my God, I just need I think I need $40 million or something like that, and I could have made the whole thing work. And of course, now they're much more money than not much more, saying much more money, it doesn't even qualify it. I mean, these were apartments that we could have bought for 250,000, 300,000, 400,000 each, and now they are at least $1 million each, these apartments. So aside from all the income from the rents, we could have made 4 times our money back on that thing. So next time it comes up, hopefully I can find more people who are interested. Let's see. So anyway, so that's what these guys do, and I know that business well. Therefore, I wanted to jump on that property as soon as I could. Valero, of course, a refiner. Speaking of refiners, so we knew they'd come back and do well. Also played oil, which came back obviously. AT&T, you guys know I always love AT&T anytime we can get it cheaply. So those are my top trades. That's a whole quarter's worth of top trades, like the most obvious things in the world, because you hear me talk about this kind of stuff all the time in these webinars. And that's where they come from. So recently, what have our top trades been? Frontline Tanker Company, right? We like them. That was just last week. Two Harbors is a REIT that I like. AIV is apartment management. I love these little management companies. Obviously Philip Morris or Altria, whatever that one is. That's Altria. U.S. Steel and Rio Tinto for the commodities trade, which are both coming back down now. They were doing well, now they've come back, but I still like the trades, of course. SunPower, as usual. Anytime I can pick up SunPower on a dip, I'm there. Walgreens again, anytime I can pick up Walgreens on a dip, I'm there. WTRH is a DoorDash competitor and a Grubhub competitor. And we like these guys. I don't know how they're doing now. How are they doing? Now, see WTRH, when you compare their pricing, like there's not a lot of difference between these companies. Oh, they're back at 186. So I just think, like, compared to the multiples that Grubhub and DoorDash are getting, they're getting no attention, and I think people are going to start hearing their name more often, and that's going to turn into a winner. TD Bank, like those guys, and now we're back to April 20th, of course. That's here, so it's right about the same price. They had a little pop and they came back. Big Lots. So, that's how the top trades go. And of course, you got to give it more than, April. So you got to give it more than 2 months to mature. But we've been picking these things out. And then to get in our portfolios, that's a whole nother thing. A lot of times the top trade's going to end up in a portfolio, but going in the portfolio means we're committing, means we're taking a serious commitment to a stock. And our paired portfolio is a long-term plus the short-term portfolio. They actually went down $5,500 over the month, and that's because if you look at the let's go short-term. Well, that's not going to go back a month. Is it daily? Okay, so basically from the middle of from whatever in May when options expired, May 18, 19, 20, 21, 24. So May 21st. So basically from May 21st until Friday, we were dead flat. And we had been playing basically a bit bearish. So we just, the portfolios themselves just basically stuck together and stayed where they were. But that's fine, because where they are is $2.1 million from a $600,000 start. So I'm not going to go over the positions. There's tons of them, but everything's holding up pretty well. And the question is that we got to look at, we made a lot of adjustments here, but we didn't really throw out any positions because they're all good. These are a lot of really, really good positions. And unless the market shows us that it's going to crash. So the way we look at this right now is we have $2.1 million, right? We kind of have a stop on the portfolio at $2 million. So if it goes below 2 million, then we're going to probably pull the plug and take the 2 million off the table and start again with 600,000. That's the way to play it. Then see, that's the point though. Ideally, we would take the 1.4 million that we take off the table and don't reinvest. We would take that and put it into bonds, but you can't put it into bonds because bonds suck. So your long-term play. So we want to probably put it into like an actual investment, or something like our hedge fund, the income producing hedge fund, which at least, sells calls and puts, like the butterfly portfolio, to put off, to throw out an income, because you got to do something with it other than leave it sitting in a bank. That's not useful, but also you don't want to mess around with it and put it into risky positions. So what was I saying there? So then I remember what I was looking for. Yeah, I was looking for how much we're going to make. So as it stands now, the 2.1 million that we have is going to make $676,000 if things keep going up. And obviously, over the course of 18 months, we'll be adding more stuff. But so 676 divided by 1150, 58%. So in the next 18 months, the current positions, if everything keeps going up, is going to make 18%. Why did I say 35%? Oh, because not 1.15, it's 2.15. 2150 divided, sorry. 676 divided by 2150, big difference, 31%. So, I don't know where that is, but we're going to make 30 something percent of the portfolio over the next 18 months. So, and of course we'll add to that, and it'll go up well over $1 million by the time we're done if things keep going well. And so, is that worth keeping? Sure, that's worth keeping. That's a nice return on our money. So we're not going to throw that away. So the reward, put it this way, the reward is 676,000. The risk is 150,000 that we're going to pull the plug if we go there. So, and we have a hedge, of course, in the short-term portfolio. We may not even lose that money. But once the combined balance goes below $2 million, we will probably very, very much start to unwind our long positions so that we can get back to cash and make sure we keep $2 million. So currently we're risking $150,000 against the potential for $670,000 in gains. That's a fair risk reward ratio. You've always got to know this in your portfolios. Am I taking a worthwhile risk? I got 500,000 more upside than downside. So the only reason I would then not want to do it is if I really don't believe in the upside. And although I'm skeptical about the upside, the reality is the market just keeps going up. The government is 100% behind the market going up. The Fed is 100% behind it going up. So the thing you need to worry about is when the Fed and the government no longer have the ability to keep the market going up, because obviously they're going to do everything they possibly can to keep things moving. So I'm not going to fight the Fed and the government trying to move the market higher as long as they keep on that track. So if Powell keeps saying his bullshit and Biden keeps telling you he's going to give you more stimulus, and there's not a tremendous amount of pressure from other avenues to change, and people aren't freaking out about inflation yet because everybody's convinced it's not going to be around long. And so there's no emergency reason to change horses or do anything different. That means that there's no reason for us to jump off this path. We have a path where if it keeps going up, if the market keeps going up and it doesn't fall apart, we're going to make $500,000. If it does start falling apart, we're only going to lose $150,000 and we still have $2 million. And then we take that $2 million, put it into cash, and we start again, and then we wait for the market to give us real bargains. Then we would get, which we did, by the way, in September. I mean, in September of, when did we start this portfolio? Oh, God. It must have been September of 19. No, it wasn't 19, September 18. Because this has been cruising since then. Here. 19, right. So in September of 2019, we dumped out of our portfolios. That's the dividend portfolio. They're all going to be the same though, the long-term portfolio. So it's September that we pulled the plug, and then we put $500,000 back to work in the long-term portfolio and $100,000 back to work in the short-term portfolio, and we started again. But we were, and you can go back to the portfolio reviews and check all this stuff out, because that's what, I mean, that's what you should do, especially if you're a new member. Because I mean, this is how we build our portfolios. If you go back, oh, sorry, it's a wrong, totally wrong place. If you go back to the portfolio reviews, so that's March 2019. That's too far back. This will be cute because let's see what we're. Here you are, January 2019. So that's the money talk portfolio was still pretty big. Okay, so here's the butterfly portfolio. Oh, I'm sorry, we didn't change the butterfly portfolio. Damn it. Where's the long and short-term portfolio? Okay, here, the LTP, STP. Wait, why are these not? How confusing. Wait a minute, what? I don't know why there's still a portfolio there. I know we did cash it out. Oh my God, we still have the options opportunity portfolio. I forgot about that one. God. Short-term portfolio review. So these are 2018. Wait, am I crazy? What? This is started 2019. And what the hell am I looking at? This is 2019. Oh, this is January 2019. I thought I'm going crazy. Stupid. I am going crazy. That's so funny. So if I killed the portfolio I killed it in late 2019. So that means January 2020 is when they were new. There we go. That makes more sense. See where we were? That's cute. 644,000. There we go. Now it makes sense. So here's the short-term portfolio, and it's interesting because we have a lot of trades in the short-term portfolio. Why? Because we didn't have a long-term portfolio yet. We hadn't built up the position. So we made a whole bunch of short-term trades to get the thing started, and we were up $44,000 in the short-term portfolio. That's where all our profits were. All of our trades were short-term trades. There was no long-term portfolio. That's funny. Or maybe there's a couple of things, but I mean, it was very small. Money Talk was this baby little portfolio here. We just made it, see, November. Everything was done in November in the Money Talk portfolio. The Hemp Boca portfolio, which we don't do anymore. We have that one. Because they used to have a radio show, they don't have it anymore. Here's the old earnings portfolio. But see, this is good because this is when we had all these positions were brand new. This was our building portfolio positions. What are you? You're the dividend portfolio. We put that one up. The butterfly portfolio was that one was still running. That had older stuff in it, I think. Oh, that's it. We didn't even have a long-term portfolio. That's so funny. Oh my God. So the short-term portfolio had short-term positions that were 2022s, 2020, 2022. There were no long-term positions at the time. So we had our $600,000, and by January we hadn't even made any long-term portfolio trades. But that's what saved us. Okay, so we started this portfolio in October, and by January, which is 3 months later, we hadn't even made a trade yet because I kept thinking the market was going to collapse, and it didn't. But it did actually in March. So it worked out for us anyway. But I thought the market was going to collapse just because it was too high in the first place. but then it ended up collapsing because of COVID. Fortunately, we had not committed very much money at the time. We hadn't committed anything in the long-term portfolio. We were playing with the short-term portfolio and making a lot of aggressive plays, and we were doing well because the market was doing well. But then when the market crashed, we started buying for the long-term portfolio like crazy. So it's that's lucky. Everything's luck. Everything's a little luck and a little skill. I mean, that's lucky, but it's lucky because we did the smart thing. We didn't carry a $2 million. We didn't carry $2 million worth of positions into the winter holidays because I felt the market was overvalued and I didn't want to keep going when we had $2 million in September. It was the same thing though. Back in September of 2019. We set stops at $2 million. And I said, if we can't hold $2 million as a combined net, I said, why are we risking our money? I said, it doesn't make any sense. I said, that's crazy. You don't take a portfolio that was $600,000 2 years ago. Now you're at $2 million and you're going to treat it like, oh, well, if we lose 200,000, what's the big deal? It is a big deal. It has to be a big deal. You can't just because you have a lot of money doesn't mean you should disrespect the money you have. And so there's got to be a way you look at your portfolios and your money. You have to keep it in perspective, and you have to also keep in perspective that tripling your portfolio, even especially if it hasn't been 10 years at least, that you're ahead of the game. That you don't need to keep going at that pace. And the other thing that we did is we were able to be very aggressive because we have all this money, because we took 1.4 million off the table and played with a fresh $600,000. We are able to be much, much more aggressive with the $600,000 than we would have been. That's why in the short-term portfolio, we're cranking it out because we're short on Chipotle. Oh, I'll make this bigger, I guess. We were short on Chipotle. We were long on Freeport. We were long on IMAX. And you see, it's the same guys all the time. MJ was a butterfly play. We were selling a lot of premium on the MJs. On Altria, we were long on Altria. We had the SQQ hedge in the short-term portfolio. That obviously ended up making a huge amount of money. Yeah, wow. Imagine how much money that thing made. We were long on TD Bank. We were short on TLT on bonds. And look how well that one did. Holy crap. What happened to TLT? We were, oh wow, we shorted. Wait, no, that's TD. No. We had the 148 puts of TLT. Oh, we don't go back that far. Well, that's just way too high for TLT. Yeah, what a ride, right? No, that didn't go well, I don't think. We got blasted out of that. Oh, no, not there. TLT 2020, 148, 140. No, that's a loser. That went the other way. I didn't realize that. Wait, where'd that chart go? So that was the oh, I'm sorry. No, I'm right. January 2020. Oh, I'm getting my years wrong. Yeah, there it is. So it actually did come out right where we thought. It came out at 140, 138. So yes, we had a 148, 140 spread. So it actually came out dead on. And we shorted the 145 calls. No, it was the next year we got screwed, I think. Toll Brothers, we were long on Toll Brothers. We had the Tesla short that didn't work out, I don't think. And then we were long on Vail. But you know, we had been ripping it up because this portfolio was only a couple of months old, and we had made some really good progress on this thing. And you see that cash on hand, we have even though the balance is 144, we have 180 cash because we sold a ton of premium, which is what we like to do when we're trying to build a portfolio. Wow, nobody has any questions. Interesting. Okay, so that's that one. So, you know, you can go back and see how we traded and how we built these portfolios. And I said, this is, so the short-term portfolio, this is now the long-term portfolio, and we'll make it a new, oh, I see. So we, at this point, these positions, I said, this is now the long-term. Oh, I remember doing that. That's right. We had gotten enough positions in the short-term portfolio because we picked them up and we said, well, if they don't go well, we'll adjust them, but they were going well. So I said, I'll tell you what, this is now the long-term portfolio, the short-term portfolio, because we didn't have a long-term portfolio yet. So we changed this to the long-term portfolio, added $400,000 more to it, and we made a brand new $100,000 empty short-term portfolio. But in other words, so what we did is we made a whole bunch of short bets, of short-term bets, and then once they established themselves, and these are obviously established because we're already up 40%. So once they establish themselves, we turn them into longer term positions. So that's how we did that portfolio. See, and then you can go to newer articles. Oops. There's a March portfolio. So by the March portfolio review, we would have had a long-term and a short-term portfolio. See, I said, see, we're loaded with cash. Our positions have a negative $175,000 net value. So the trick is to work out of the positions. So we sell so much premium that we have more cash than our portfolio is worth. But that's the whole point of it, right? I mean, that's what we want to do. We want to sell as much premium as possible and let time do its work for us. And this is what? This is okay, so what happened in the last cycle is we had a couple of big market sell-offs. We cashed in the, okay, good, it's worse. But then it didn't get worse, and the STP got bigger and bigger, and the LTP recovered. Blah, blah, blah. Okay, move the cash, blah, blah, blah. Anyway, so I'm not sure if we had actually done this transition yet. But you can see exactly, and this is why I do these commentaries. Look what we did. We took the positions, we decide what we're going to do with them. We built more hedges. Oh, and here's the actual long-term portfolio. Interesting. Wow. Boy, we added a lot of positions quickly, didn't we? Oh, no. That's because, I get it. That's because, I'm sorry. That's because the long-term portfolio was the short-term portfolio. That's where all those positions came from. So we moved everything over. Oh, and look what we did here. We sold a ton of puts, which is, again, a very big part of our strategy is when, because the market fell. This is why it was so easy for us to make money that year. Look what we did. March 17th, March 12th, March 23rd, March 12th, March 17th, March 18th, 226, 313, 312. So when the market collapsed, we sold the crap out of puts. And what do we do here? It's 7, 25, 37, 30, 40, 50, 55, 60 something, 60, let's say 70, 82, 85, 90, 100, 110, 120. It's about $120,000 worth of short puts. That's why we have so much cash. Holy crap. So when the market crashed, we sold $120,000 worth of short puts. And what did we do? We promised to buy Apple for 150 minus 1450, so 135-ish. We promised to buy, and then we promised to buy Apple further out or for whatever, I don't know what we did. I guess we did it twice. So first we promised to buy it for 230. Oh, I see. We lost money. It went further down. So we promised to buy Apple for 230 minus 37, which is $200, and it was at 219. We promised to buy Apple for $200 net, and then it went lower, and so we said, well, screw that. So we sold them 150 puts, promising to buy it for 135 net. We promised to buy ADP. We promised to buy Boeing. Almost got killed on Boeing. And look, these are not doing well because we didn't time it perfectly. The market totally crashed on us. But it was sensible, logical choices. We said, if these stocks get this low, we will buy them. Caterpillar, we will buy it at $50 minus 5. We weren't being brave here. Clorox is at 171. We promised we sell the 110 put. Energy Transfer is at $5. We sold the $10 put for 220. Got burned there. Haynes, which you guys know we played a lot, was at $8. We sold the $8 puts. Put our foot down at $8. IBM at 92. We sell the $80 put. Intel 47. We sold the $30 put on Intel. Holy crap! that was our trade of the year too. We were real happy about that. Here's Lockheed Martin at 272. We sold the 160 puts. People pay crazy prices for puts. When the market's crashing, people lose their minds and start selling puts for start buying puts for crazy prices as if Lockheed Martin's going bankrupt. MDT, that was 75. We sold the $60 puts. Vail again, 137. We sold the $100 puts. And THC was 14. We sold the $15 puts. That's a pretty aggressive sale. And all of them are losing money at that point. $120,000 worth of puts, and they're down $30,000, $40,000. So we had not called a perfect bottom, but of course all these prices are, once again, they look ludicrous. At the time, it's a gut check. You gotta hold on to it and say, okay, I believe in my valuation. But if you don't believe in it, and also more importantly, if you are not really willing to buy, and we couldn't afford to buy all of them, but you've got to be willing to buy some of these stocks. Every individual position, you've got to say, I'm willing to buy it. What in reality, if it dropped another $40,000, we'd be down $80,000, and we'd be in a position where we'd have to start saying, okay, we're actually going to take possession of Apple. We're actually going to take possession of Haynes. We're actually going to take possession of IBM. We have to pick 4, 5, 6 stocks that we take possession of, take the loss on the rest, and say, okay, that's where we are. Now, if I took the loss, if I converted though to owning the stock on Apple, and I converted to owning the stock on Boeing, and I converted to owning the stock on ET, and I converted to owning the stock on, well, those are my expensive ones, $10,000, $20,000, $30,000 worth of the loss, 30 out of 40, I wouldn't be losing because I'd be buying the stock. And still, obviously, it's still a loss. But in other words, if 30 out of $40,000 end up being positions I really take, then I'm not wasting the loss. I'm rolling it into a position, and then I'm only losing $10,000 extra on the other positions I speculated on. And that's what I mean by you have to really want it. You have to really want all your positions, and the positions you lose a lot of money on, assuming they don't suck. But positions obviously Apple's a no-brainer. We would take that. Boeing, it was a little tricky at the time. I don't know if Boeing would have been my top. If Boeing was down further, not because of the engine issue, because they have that grounding issue with the wings and all the problems they had. If Boeing was down not for that reason, but because the market was down, then yes, I want to go ahead and buy Boeing. If Boeing was down because something else happened with the FAA and they were going to be grounded for longer, or they couldn't fix it, or so on and so forth, that would be a different story. But we had already priced in where we were comfortable with Boeing on an entry. Same with Energy Transfer. Why are they down? And if they're down for what we consider not a good reason, we are going to be very, very happy to convert that into owning the stock, selling puts and calls, lowering our basis, and then waiting for the market to come back. That's how you build positions. So when we sell short puts, it's a great example of our strategy. When we sell these short puts, we don't know which position we're going to end up owning, because it's going to be a combination of which position gets cheaper, and Energy Transfer really fell off the table, which position gets cheaper, and which one do we still believe in even though it got cheaper. So how did ET end up? Oh, look at that. so this was what am I on, 2 years here? If this is 2 years, how come I can't see? Wait a minute. This is 2020 3/24. I keep looking at the wrong date, right? So this is, there you go. So this is 2020 3/24. We had picked up Energy Transfer a little too early or something, or whatever the problem was. Well, what date did we do it? We sold, oh, it was 2/26, that's why. Aha. So on 2/26, we sold the $10 puts for 220. So here's what happened to us. So on 2/26, oh wait, right around there. Okay, so right around here, we saw it went down to here. We thought 10 was going to hold, and we sold the $10 puts because we thought that was a great price for Energy Transfer. Then it got destroyed, and then we're doing the review, and this thing is now these puts are $6 on us, the $10 puts, because the stock's at freaking $5 or $6. But we look at that and we say, oh, that's bullshit. And I think we did, though. I think Energy Transfer is in one of our portfolios as a stock play now. But then the point is, if we really want it, that's not a problem for us, because what happened? We're forced to buy 2,000 shares for $10. That's $20,000, first of all. It's not a big deal. We're forced to buy 2,000 shares for $10. Well, we lost $8,800 on the freaking options. But all this does is force us to buy 2,000 shares for $10. Then we buy another, nope. So we have to buy 2,000 shares for $10. We buy another 2,000 shares for $4.83. Okay, so that's $14.83. 1483 divided by 2. So our average would be 741 with the stock at 483. Then we could sell calls and lower our basis more. I don't know what the price would have been. Well, for one thing, we could have sold $10 puts for $660 and lowered our price even more, but that would be a little risky. But we would sell probably the $5 puts and for at least a couple of bucks, and we'd knock $2 off that price. That would bring us down to $541. And then if we sold calls, we could have sold maybe the $6, the $7 calls, $7.50 calls for another buck, and we'd be down to $441, which would be lower than the current price of the stock. And so we'd have a stock at $441 with a call away at $7.50. What's wrong with that? And the funny thing is, that's where we'd be after the stock falls 50%. We'd be in a position where we're really, because we really want to buy the stock, there's no penalty for us. See, and this is why these reviews are really good to go over, especially when you're learning, because you go back and see these things and you think about, what did we do, why did we do it, and how did we react when it happened? And if you're just buying a stock because someone told you to buy it and you don't want to own it, it's not really a stock you would love to own, then you're going to bail and take your $8,000 loss, right? But if it's a stock you really wanted to own, we turn around, we double down, we say, oh my God, are you kidding me? And again, remember allocation blocks, right? We have, in the long-term portfolio, we have $50,000 allocation blocks. That's when we started, we did. Now they're much higher. but we have $50,000 allocation blocks. We committed $20,000 to buying Energy Transfer. So when Energy Transfer, when we used $20,000 of an allocation block, when it gets cheaper, we use another $10,000 to buy 2,000 more shares. Now we've only spent $30,000 of our allocation block. And that's not counting, by the way, the money we collected for the put. So we actually, how much were these things? We sold those puts for $220. So we're at like net $8, net $780. So we only spent $15,000 of our $50,000 allocation block on the initial purchase. And then we buy another 2,000 shares. So I didn't even count that correctly because we bought it for less money than I thought. So we spent 780 times 20. We spent $15,600 on the first 2,000 shares. Then we buy, let's say, at $5. Then we buy 10. Then we say plus $10,000, and now we have 4,000 shares. 2560 divided by 4,000, and now we're at 640. So now our average price is 640. And like I said, we could then lower the price further by selling puts and calls. If we sold the $5 puts for $2. Then we're obligating, then what would we be doing? We're obligating ourselves to buy another 4,000 shares, but for net, well, for $5, let's see, so we're going to spend another $20,000. That would then finally bring us to a full allocation block. So we would end up with 8,000 shares at an average price of whatever the hell that works out to. But like I said, then we could sell the 750 calls. And so we drop it. So we drop our price to 440, our net, and then we would be called away at 750 with a huge profit. So even down here, you have to say, gosh, I think it's going to bounce back halfway and get to 750. So we hadn't filled our allocation block. We had plenty of spending power, and we're ready to go. That's what you do when you follow the rules. But notice it's a slow process, and you have to be patient. You have to take these very small initial positions so that you can have that flexibility when the market crashes. And that's how you build your portfolios, one step at a time. And the biggest first step we see, it's very funny because when you look back at this thing, the long-term portfolio in 1 month, when we started building, when we did what I said we were going to do in January, we finally got around to it. We set up a long-term portfolio, and the first thing we do in our long-term portfolio is we picked 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. We picked 14 stocks that we would buy if they got cheaper. Sold puts on them. If you'll give me the stock for this price, I'll buy it. As soon as the market crashed, that's what we did. We jumped on these positions. And then the rest of them, and by the way, look, we're taking a lot of hits in the long-term portfolio here because we invested at the wrong time when we started it. And we were down to $100,000. We were down 80% because we were riding out this crash. So we couldn't afford to do much with it. We got hit terribly hard by it, but we stuck with it. We made the adjustments we could make, and it rode back up. Basically, we were lucky because if the market had gone down further, we could have been wiped out. But we got aggressively long right when the market was crashing. But that's our gut reaction. When we have a sell-off like that, we say to us, not that one. Where'd it go? Oh, and I'm sorry, by the way, the point is also on the short-term portfolio. Where is that? The short-term portfolio was up 182% because of the same crash. So we had, remember that we had $600,000 total to start. Now we have 282 plus 100 is 382. So we only really lost a third of our total amount of money. 80% of it was lost in the long-term portfolio, and the short-term portfolio made up about half of the losses, which is exactly what it was designed to do. So although the long-term portfolio doesn't show the cash, we have the cash in the short-term portfolio to make all the adjustments. And that's the whole point of that strategy, to have the short-term portfolio that makes money when the market goes down. When long-term portfolio loses money and the market goes down, you take the money from the short-term portfolio, use it to offset the long-term portfolio and buy more positions. And again, assuming you like the positions, assuming the world's not going to end. And as you guys know, I'm very good at that. I'm very good at calling the bottoms on these things. And the reason it is because the same thing as everything else. So I'm just looking at the total value of the market. I'm looking at the fundamentals. I forgot when it was, but I pointed it out just the other day that I'd written an article back at this time saying, even if this happens, oh God, I think it was in the portfolio review, actually. It was in the Friday portfolio review. That is when I wrote that. So this is why our portfolios are up so ridiculously now, is because we just happen to do everything perfectly right at the beginning of the cycle. So where was I? No. All right. I remember saying it last week, but I can't remember where I said it or where I pulled it up. It was one of the portfolio reviews anyway. So, boom. But the point is, what I had said at the time was, even if the market does this, and even if we all stay home and no one does anything outside, I took apart the economy and I said, here's how much consumer spending is. Let's say there's zero consumer spending, which is obviously bullshit. But let's say there's zero consumer spending, then we still have a $12 trillion economy. Even if you take all the consumer spending out of the economy, still $12 trillion of spending. I said this market is being priced as if it's going to be below $8 trillion. Therefore, this is the bottom. And the government stimulus was already coming. They were already doing the stimulus. They were already putting money into the economy to fight the virus. They were already discussing measures. The Fed was already cutting rates. All these things were already in progress. Obviously, they just didn't show up in the market at that moment on that particular review, which was March 21st or something like that we did the review. But it was obviously coming. And if it's obviously coming, this is the time to buy. And you just got to read the signs. You just got to follow the news, pay attention to what's happening, and then pay attention to your values. And it wasn't about buying momentum stocks. You see the stocks we're buying. Value, value, value. Every single one. I'm buying Intel. I'm buying Microsoft. I'm buying Boeing. I'm buying IBM. I'm not buying freaking, I'm not buying Airbnb. I'm not buying Roku. I'm not buying Tesla. It's like we don't, yeah, they could do great, and they did do great. But I'm buying stocks that even if everything else goes to shit, they're still good stocks and they're still going to make money. And you don't know that with these other stocks. You don't know that with the non-blue chips. You want to stick with the blue chips in a crisis. And look how well we did. Look, here's where we are now. 383 at that crash, and now we're at $2 million. But and again, it's because we basically doubled down on everything. At 383, we took more money and put it to work and took all of our cash out of the short-term portfolio, put it into the long-term portfolio, and took all the profit we made on the short-term portfolio and went and doubled down on the long-term portfolio. That's what we did. And that gave us incredible buying power in the long-term portfolio, and of course, everything more than doubled from there. But that's, it's great to go back and review and look at the decisions we made along the way and what the logic was and how we got there. And frankly, I look forward to cashing everything out. I am going to be happy to not have $2.something million worth of positions and to go back to a nice $600,000 that we can have fun playing with. Especially, and that was the other thing, by the way, of this crash, because we also had 1.4 million on the side. We just took 1.4 million off the table from the previous day. It was more than that because we weren't at 2, we were higher than 2. But we took $1.4 million off the table, and that was at the sidelines too. But I'm not even talking about that money. We just used it. We stuck with the 600,000 we had to make our changes. But when you do this, when you have this kind of gains, when you've got this kind of money because you made profit, and you go back to the regular amount of money that you had that you started with, especially in the short-term gains. I mean, you don't need this much money in play. But having on the sidelines, if anything does go wrong and you've got that kind of money on the sidelines and you deploy it, that's when you get a huge home run. That's when you get these kind of returns. We didn't take the money. We never needed the money from the sidelines, but we said to ourselves, in an emergency, at least we had a good cycle last cycle. So if things are, basically our attitude was, well, I can't imagine how things could get worse, so we're going to double down. If they do get worse, well, at least we had a positive. At least we still have the money from the sidelines on the last cycle. And you've got to be like that. You should always have money on the side. You should always have money left to deploy in a portfolio. You should not overcommit what you've got. You've got to be flexible and you've got to be prepared for a crash. And if you don't have the money outside your portfolio, then you better have your portfolio really well hedged. We had a little of both in the last cycle, and that's what brought us to the point we're at today. But the point we're at today is we made a ridiculous amount of money. It's too much. It doesn't do us any good to really keep redeploying the cash. Of course it does, but I mean, we're not learning anything from this. It's better to start from scratch, build a new portfolio, and go through the cycle again. And again, it goes back to remember where we started out. We started out with $600,000. Now we're putting 1.4 million away. And we're starting again with $600,000, but we put the 1.4 million away. That's doubling what we had is in cash put away. And now we can play with $600,000. And if we do it again, then we have $3 million put away and we're playing with $600,000. How is that a bad thing? The problem is that the money we're putting away, you got to figure out what to do with that. That's what the problem is. And we talked about that. We have the dividend portfolio or the butterfly portfolio with other strategies that are less risky that we can do that with. And we have, for reality, we have that hedge fund that's an income producing hedge fund that's also taking less risk, and it just throws out the cash. And that's going to get you your 10% returns that you're looking for the long term. All right. Anyway, good. Hey, my voice held out this time. That's fantastic. All right. So thank you all for coming. I hope somebody learned something. But yeah, I strongly suggest, think about how we build these things and what we do with these positions. And we will talk about some more. Well, next week we'll talk about other stuff, I'm sure, but hopefully the market holds up. How are we doing, actually? Take a quick look. Index is up, all good. Everything is beautiful. Everything is fine. Nobody's worried. The VIX certainly isn't worried. Look how low it is. All right, so very cool. We're heading into July 4th weekend, so it's going to get quieter and quieter. And that'll be interesting how the market performs when there's basically zero volume. And you're going to see the volume. Look at the volume falling off here. We're not even there yet. We're, we got another, I don't know, when is July 4th? Oh, it's not far, right? Basically a week from Friday. I forget that. 1 week from tomorrow, and everybody's done. This day is going to be dead. This weekend, Monday's an official holiday. We're not even open on Monday, so everybody's going to be out of here July 2nd, I'm sure. So we're going to just diminish. This entire week is going to be so slow next week. So there's not much left, not much trading time left, and like I said, we're going to, we're fine. We're well hedged. Our short-term portfolio is well positioned. I think everything is good. And like I said, the real buffer though is, if we go to $2 million, we're out. We're going back to cash. Then we'll just see what happens. We can always make money. We can always promise to buy stocks for a lower price, even now in the long-term portfolio. Look at this. So how much did we have last time? We had 120,000, right? Here we have 5, 6, 7, 10, 20, 28, 36, 46, 56, 60, 70 something, 73, 83, 88. Call that 20 more. It's 108. Oh, same thing. It's about 120,000. It's interesting, right? So here's 120,000 on 17 stocks we would love to own if the market crashes. And what are they? Aflac, Akamai, Boeing again. We never get to own Boeing. We always promise to buy it. We never actually get to get it. Chimera, Discovery Financial, Ford, Frontline, Halliburton, Harmony, Lebu is biotech ETF, Macy's, and Mitsubishi, that's Mitsubishi Bank, OIH, Rio Tinto. You know what's funny? It's very similar to what we had last time. SCTD and that's the Alcoa spinoff. Very, very similar kind of mix. So I guess I'm consistent like that. And notice the commitment amounts, right? $50,000, $45,000, $100,000, $30,000, $20,000, $60,000, $25,000. I'm not counting the net. $25,000, $40,000. So again, it goes back to the same thing. It's like there's no one position that's going to totally kill us. We're committing to buy 50,000 this, 50,000 that. Generally, it's 50,000 blocks. We're committing to buy 50,000 this, 50,000 that, 50,000 that. In this portfolio now, it's a $2 million portfolio basically, 1.9. So, you know, our allocation blocks would be at least a couple $100,000 each. So again, it's 1/4 of an allocation block that we're promising to buy. In no way, shape, or form is that going to hurt us. If they all go bad at the same time, that would be annoying. But like you saw, they did all go bad on us in last year. They all went bad at the same time, but we survived it. We took a pretty small hit. The hit was 10% of the portfolio, basically, was the hit we took. Right now, we're obviously ahead. And if we go back and take a 10% of the portfolio hit, we could lose $200,000 in this section, but it won't kill us. And that's the point. And if we win, we make $120,000. But these short puts aren't about having a better winning losing. All we're doing is promising to buy Macy's for $8 minus $4.60. That's crazy. We're promising to buy Ford for $12 minus 2 is 10. So we're promising to buy these stocks after they fall 30, 40%. That's not a bad thing. That's how we set up for the next cycle. If we cash in the portfolio, we would probably leave most of these things on because we still want to buy these stocks. We really would like to buy these stocks for the next cycle. All right. Thanks a lot, everybody, for coming. Appreciate it. We'll do it again next week. Take care.